Good afternoon, good morning, good evening, everyone. Welcome to our Diary of a Trader video series. This is on Japanese candlesticks and how to interpret this particular chart style, which is kind of turned into the de facto chart style in all of technical analysis education. Hands down, it's probably the most well-known and popular among traders when when we're talking about charting and technical analysis. We don't know when they first came out or began, but we do know that that they started showing up a little bit around the late 1700s, early 1800s, and we do know that they were very prominent during the Meiji Restoration in Japan. The creation of these is attributed to a man named Munehisa Homa in 1724 to 1803 is when he lived. His nickname was Sakata, and he used these in the 17th and 18th centuries. Predates American bar charts by a good amount. American bar charts, those used to be the kind of de facto chart style prior to Japanese candlesticks, but American bar charts weren't created until the 1880s. Sakata was heavily influenced by the use of the number 3, which is extremely that is an extremely important number in Japanese culture. You can view it the same as we view certain numbers in Western culture as very important, like 7 or 13 is an unlucky number. And consequently, though, the number 3 is an extremely important Gann and Elliott number as well. It's a very interesting kind of correlation between two different styles of technical analysis that have a shared relationship when it comes to the numbers. And if you ever delve deeper into the difference between Japanese analysis and Western analysis, you'll see that there's a significant amount of correlation between the two. So the reason that candlesticks, Japanese candlesticks, are so popular, it's related to how they tell a story. Okay. Each candlestick, regardless of the time frame, tells us something that is happening, all right? And it's made up of several components, but really the primary two components are known as the wick and the body. Sometimes you'll hear it referenced to as the shadow instead of the wick, but the body is usually it's that thicker rectangle part, and the wick are these lines that jut above and below the body, okay? The thick part of the candlestick is called the body. That shows where the open and the close of a candlestick was. And then the thin lines above and below show us how far something traded above and how far something traded below. You'll often see these represented by OHLC, open, high, low, and close. And so when you see candlesticks like this, the default style these days is to color them green and red. So whenever you have a candlestick where the close of the candle is above the open, they shade it in green, indicating that prices moved higher. They closed higher than the open. The inverse of that is true as well, where we have the close below the open, and that is represented when they shade it in as red. And the high is saying that this is the highest point that price traded within the candlestick. The low is the lowest point that price traded. The open is where price started at, and the close is where price stopped. Regardless of how they are colored, traditionally Japanese candlesticks are colored. They're either black or white, or they're called black or hollow, or they're just called hollow candlesticks. So that's how they're usually referenced. But regardless of the coloring or the shading, any candlestick that has a close above the open, that is considered a bullish candle. It's I don't know if you really want to consider it bullish, but it's considered that the close was bullish because it closed higher than the open. And any candle that has a close below the open has a bearish lean to it. Again, candlesticks tell us a story, and they tell where something started, how far it went, what did it do, how far down, how far high, and that's what we're talking about. So if you look at the candlestick that's here, it's shaded. This is a daily candle, daily candlestick, meaning that there are 24 hours in a day. So this is the entire trading range of that day. Now, something that we can do is if we want to know, okay, well, what happened with this candle during the day? Well, we can kind of, quote, zoom in, okay? So we can go from a daily chart to a 1 hour chart. All right? And so if you look at the highlighted area, that is highlighting the exact trading range. Okay? If we go back one slide here, that daily candle, these hourly candlesticks are inside that. There's 24 candlesticks, and that highlighted range represents that. Something that we can do is we can kind of draw the pattern of that daily candle inside. So, the daily candlestick is drawn over the 24-hour candlesticks to show kind of that zoomed in view I was talking about. So there's the open. And then you see that price, as it moved along here. If I can get the cursor, here it is. So here was the open, price went down. That's where the low's at. And then it moved up and it traded this high. So that's where that wick comes from, the high of the wick. And then ultimately we trade a little bit lower until we closed. All right. And that's how that candlestick got formed. But we can bring it in even like a little bit tighter if we want to. So we can go from that daily to the 1 hour we just did. Now we can go from the hourly to the 15 minutes. So now we're looking at all the 15-minute candlesticks that are within a daily candlestick. And then you see it even in a more zoomed in view. That's what it looks like. So basically what we're saying is that 15-minute chart with all those candlesticks is that. All right. So I just kind of want to make sure that everybody's grasping this, is that the first candlestick that we looked at here, all right, this daily candlestick is the same as all of this activity in here, okay? Now, each candlestick itself has a specific kind of interpretation to it, but that's for a separate video series that we'll be doing. But how you view it, how you understand it, interpret it, this is what a candlestick chart is. This is how it's constructed, and this is how it's viewed. I will say that it, compared to other forms of charting, this Japanese candlesticks, while they are the de facto style of learning charts these days, I don't believe it should be, because Japanese candlesticks are a fairly advanced form of analysis. They are used on time frames which are inappropriate, not intended for the original use of candlesticks. Candlesticks are an extremely, extremely, extremely powerful chart style when you use them on a longer term time frame. But the way that you would interpret a candlestick on a weekly chart is not the same way you're going to interpret a candlestick on a 15-minute chart. All right, you could have the same candlestick with the same kind of construction, but because the time frame is so small, it's just not going to have the same kind of weight that you would attach to it as you would on a weekly chart. So just keep that in mind, that there are other chart forms out there that are much more appropriate for faster time frames, but I would struggle to find a more useful and powerful analytical chart style for longer time frames than Japanese candlesticks. Thank you for watching this video, and I look forward to speaking with you in our future videos.